SoundHound reported quarterly financial results yesterday after the markets closed on Thursday, February 27. And on the day after the announcement, the stock price is up over 17%. Of course, I'm happy about that. I know SoundHound AI is a popular stock among retail investors, and I always like to see retail investors making money. It encourages more investing, which I think is a great way to increase your wealth in the long run. In this video, I'm going to review SoundHound AI's latest quarterly earnings results and update my buy recommendation for SoundHound AI stock, looking at my discounted cash flow valuation, and sharing with you what I think a fair price is for this stock and whether or not I think it's a buy, hold, or a sell at current prices. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, SoundHound AI reported fourth quarter revenue of $34.5 million, which was a 101% year-over-year increase. That was an acceleration from the previous quarter and previous quarters where the revenue growth rate had slowed down to less than 100%. So this was a nice acceleration. Of course, this is not all organic revenue growth. SoundHound AI has made several acquisitions in recent years, and that's helping the company grow the revenue faster than it otherwise might have. And two of the categories I'm most optimistic about for SoundHound AI are restaurants and automotive. And in restaurants, SoundHound AI is making considerable progress. They're already working with over 30% of the top 20 quick service restaurant brands, and they continue to expand. Every time I go through a drive-through at a restaurant, I just think to myself how much more efficient that process can be with artificial intelligence if they can make that work more effectively and expand it more broadly. It'll save the restaurants on employee cost because they won't need to have somebody taking orders at the drive-thru. It'll also help customers with more effective service because the AI at the drive-thru can be trained with all the company's data and so can serve customers better than a drive-thru assistant can help customers because the drive-thru assistant cannot be trained as effectively as an AI can be trained. It'll cost too much money to train a drive-through agent with all of the company's information and then all of the updates that are always happening, right? National brands are changing prices, changing promotions, changing menu items. And so the drive-through agents need to constantly be trained, which is expensive. And so if you have an AI, it can automatically update and it serves customers better. So this is a massive opportunity. If SoundHound AI can continue capitalizing on it, there's a long runway for growth. The next area is automotive. And this is a segment I see more and more people preferring to communicate with the car with audio. And it's not just when you're driving, but also imagine when you're trying to tune up your car and you're trying to figure out what's going on, trying to figure out the different levels and seeing what needs to be fixed and how to fix a certain thing or how to maybe adjust the controls to fit your liking better. Instead of taking out the manual and looking through all of the different things and trying to find the thing you're looking for, imagine just being able to speak to your car and say, where is this thing that I want to change? Or how do I change this thing? Or what's the optimal level of this thing to keep? And imagine the car just telling you, oh, this is where that is and that's what, and that process will be a lot faster and more effective instead of looking through the manual and trying to figure things out in that way. So I think this is a big opportunity and it's good to see SoundHound AI already capturing some customers here. In the latest quarter or in the latest few years, they added some new customers, including Lucid Motors, which is an up-and-coming EV company. In fact, Lucid Motors is increasing production this year. Up from 10,000 units last year, they're increasing to 20,000 units this year. So SoundHound AI can be on the ground floor here with a new up-and-coming company if they find more broader success, they can take SoundHound AI along with them. So the revenue growth is excellent for this company. What troubles me are the massive losses on the bottom line that are getting worse, not getting better. So revenues came in, of course, at 34.5 billion. That was up 101%. But the operating losses increased significantly. Now, the headline number of 257 million operating loss is a little bit misleading because the company has these contingent claims that change with the change in the stock price. And since the stock price increased, that caused a negative on this operating line item. The company explained the details here that cost the company $221 million in the fourth quarter. But even if we subtract 221 million from this loss, let's say 257 minus 221, would still leave a loss of 36 million in operations. That would be almost 3 times the loss that they incurred in the same quarter last year. 3 times the loss. So revenue doubled, but their losses tripled. Those are the kinds of things I'm not liking with SoundHound AI. And I've seen this from SoundHound AI. It's been a few years now. They're growing revenue, but we're not seeing very much improvement in anything else, in the line items, in the percentages of losses compared to the percentages of revenue gains. Now, thankfully, the company has a pristine balance sheet. They have about $200 million in cash and no debt, which is good news because they're burning through cash. So last year, they went through 68 million in cash flow from operations, and it got worse in 2024. They were negative 109 million from cash flow from operations. This is what I mean when I say their metrics, their cash flow and profitability are not improving with the improvements of revenue. I don't mind companies, growth companies especially, that are investing in growth to have negatives on the bottom line and cash flow. But I want to see progress towards profitability, but SoundHound AI is not demonstrating much progress towards profitability. In fact, their operating losses and cash flows are getting worse as they're generating more revenue. SoundHound AI raised its full year 2025 revenue outlook to be in the range of 157 million to 177 million. But before SoundHound AI stock investors get excited about, whoa, the company's raising their outlook for 2025. That's good news, right? They're more optimistic because they're raising their outlook. Let me share with you how much they raised it by. So here was their previous outlook, a range of 155 million to 175 million. So they now increased it to a range of 157 million to 177 million. So a less than 2% increase in their outlook for 2025. I imagine the only reason they even bothered with that increase is just so they can announce that they raised their outlook, right? They didn't raise it in any meaningful way, but they can go around saying that they raised their outlook now, which could increase the enthusiasm from stock market investors that are following SoundHound AI stock. All right, so in my discounted cash flow valuation, I calculated the intrinsic value per share for SoundHound AI stock at $3.88, and that compares very unfavorably to the current market price of $10.80. Now, that's even though I'm incorporating that the company becomes cash flow positive in 2026, which is also highly uncertain, right? I shared with you how much money they're losing on the bottom line. But I'm forecasting that they will turn positive in 2026 and their free cash flows will grow at a significantly elevated rate between now and the very long run. I have their transition period, their cash flows from the year 2028 to 2034. I'm forecasting a compounded annual growth rate of 50%. 50% I'm forecasting their cash flows will grow every year between 2028 and 2034. And even with that robust outlook, the intrinsic value per share is relatively low. Now, the company's beta is very high at 3.04, and that could decrease as they achieve these milestones, as they make progress towards profitability and make progress towards being cash flow positive. That will significantly reduce the riskiness of the business once they become cash flow positive. It's a bit risky right now because of all of that money they're losing on the bottom line and because of the big negatives in cash flow. If they can hurdle that and achieve that milestone, that'll be a step down, a big step down in the riskiness. And if you lower the beta, it increases the intrinsic value per share. I can share with you live here an adjustment to the beta. You can see right now the beta is 3.04. The intrinsic value is $3.88. If I were to decrease this beta to 1.5, the intrinsic value per share shoots up to $11.59, which would be above the current market price. So right now, the biggest headwind to this stock is the riskiness. And the riskiness can improve if the company makes progress on those important metrics on the bottom line. So for now, even though the company has excellent long-term prospects and they're making great progress, the losses on the bottom line and the negatives in free cash flow, I'm keeping the stock rated as a hold, and I updated that recommendation on February 28th. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.